Next week could be massive. I believe Nvidia's earnings could be the catalyst for the next major breakdown in the markets. I'm going to explain why this scenario can happen and what strategies you can use over the next few weeks, whether you're bullish or bearish. Let's dive in. So there are 5 critical things that we're watching that is going to decide if this turns into a bigger market correction, and none being more important than Nvidia's earnings next week. Number one is going to be whether leadership stocks can continue to be leadership. So now there have been a huge amount of money flow going into the Mag 7 stocks, semiconductor stocks, and sectors like or countries like the Kospi, which have very large positions in their AI stocks like Samsung. And so you have a scenario where these leadership stocks have been driving almost all of the returns. Now, looking here at the Mag 7 index, you can see that we have actually now had a breakdown of the Mag 7 stocks. Now, we had an attempt today to break below the 50-day moving average. The bulls saved it so far, but this is going to come down to Nvidia. So Nvidia's earnings, it's the $5 trillion behemoth out there. Earnings are coming out on Wednesday. On Wednesday, we're going to be live streaming those results. But when Nvidia's earnings are going to come out, the one thing that I feel is very high probability is that on the anticipated numbers, they're going to beat. This is not me forecasting. And if they by chance didn't beat, which I don't think is the scenario is going to happen, it would be devastating for the market. But they're likely to beat. But when they beat, the question is how much of the market euphoria has already priced in very high expectations, and they were simply not able to beat all the elevated expectations? Is it going to be one of those scenarios where the market fades on, or Nvidia fades on its earnings? A very good example of this is looking at what Oracle did when it announced its big earnings announcement, jumped to $340, and then proceeded to give it all back, wiping out over like it was, I think, close to a 30% correction from peak to trough, about, yeah, almost 40%, 39% correction from peak to trough. And so we have a scenario where will Nvidia market? This is critical because that's going to lead to the second thing that we're watching on the markets, and that is the deterioration of market breadth. What you can observe here is that back in the summer, after the huge surge off of the Liberation Day lows, we were at 85% of stocks trading above their 50-day moving averages. It was a very broad rally. Everything in the market was rising, like the tide was rising. Everything was working. This is a sign of a very healthy market. But since the summer, we have seen deterioration in breadth, including over the last month. We've spent considerable time below the 50% mark, which means there are more stocks downtrending than they're uptrending. This deterioration is important because that really shows how critical my first point was about the Mag 7s and Nvidia keeping the rally going. Because if they stall out, they make up 36% of the capitalization of the entire S&P 500. If they're not rallying and they turn, the rest of the market's already selling. This is all would be a very increased probability that there is going to be a trigger point that creates selling if Nvidia can't follow through. So stay tuned. We'll be watching that Nvidia earnings on Wednesday. So the breadth has been deteriorating. This leads me to number 3, which is the subindices. And what I mean by subindices is looking under the surface of the NASDAQ and the S&P 500, so heavily weighted. So the first thing I want to do is look at the equal weighted S&P 500. This is just saying, forget market capitalization. We're allocating an equal weighting to all 500 stocks. What you can observe is that there's been a persistent topping formation developing on the S&P 500 equal weight. The market double topped over the last couple months, had a failed rally here this week and is now once again below its 50-day moving average. So the broader market has not rallied in 4 months. On top of that, we had a legitimate breakdown in small caps today. Now, small caps were having a great rip all the way into October. They broke down here in late October. We had a very weak bounce, and today, a legitimate break to lower lows. So we have the underpinning markets continuing to deteriorate. That leads me to the fourth thing to watch, which is the financials. And so I'm watching very, very closely what's happening here in the financial markets. Why? Because historically, the financial stocks like the JP Morgans of the world are your quintessential beta 1 asset, which is essentially when the stock market is rallying, JP Morgan's rallying. When the stock market's selling off, JP Morgan's selling off. I'm just generalizing, but this has been the case that worked. So very similar to the way that the equal weight S&P 500 has been behaving, we have been seeing a big topping formation developing on the financials, including over the last 2 days, a false start rally that has already given back, giving signs that we may be seeing a bigger topping formation. And so we have, is this going to be something like a head and shoulders formation? You have a very critical neckline forming right here. And so you have a scenario where the leadership stocks are going to coming into question. We're going to have a very critical earnings. We have already the broader market deteriorating, the sub indices already topping out and or selling in the case of small caps, financials very toppy and heavy. And that brings us to the fifth thing we're watching, which is the high yield bonds, or also known as junk bonds. This is critical. There's been huge stories about the amount of money being sucked out of the credit markets to fund all these AI projects, which in many cases are all defined as high yield. There was massive downgrades on Oracle debt, all sorts of issues starting to crack. Now, the question is, has all of the excess liquidity been sucked out of the high yield credit markets? This is going to be very important to watch. We're seeing here already a double top forming, a failed rally, sustained price action below the 50-day, and trading right along a critical neckline. This is what I want to really highlight here. All of these things are at the edge of a cliff. We're at critical moments on almost all of these, and the one thing I want to stress is that in the high yield markets, in the junk bond markets, there have been a lot of 5% market corrections that have happened without the junk bond markets breaking. But whenever the junk bond markets break down, often it's associated with market corrections that are greater than 10% on the S&P 500. So we have junk bonds on a knife's edge. We have financials looking heavy, small caps and the sub indices all looking topping and breaking down. We have the breadth of the market deteriorating, and many leadership stocks are already breaking down in the Mag 7s with Nvidia's earnings on the plate. This is going to make Nvidia's earnings critical. We have the November option expiration on Friday of next week as well. And so there's a very high risk that next week between Wednesday and Friday is going to be a pivot. It's going to decide whether these markets break down. So let's go to step two here. If these markets do break down, what is likely to happen? I've highlighted that this has been this decade, the 100th percentile, the longest rally that we've had without a 5% correction, and the largest in magnitude without a 5% correction. This market is overdue. Now, at the same time, we have a huge amount of traders out there that are pivoting the sentiment because seasonality suggests that the markets are strong into the Christmas rallies. So a lot of people are looking for bull continuation on these markets, which means that there are a lot of people that are going to be surprised if this market starts to break. And what you think is that what drives market corrections is when there becomes substantial imbalances between in order flow that actually have huge amounts of orders hitting the bid. Now there's one critical thing that everyone needs to watch, and that's where this 50-day moving average is. Not because the 50-day moving average is that important, but coincidentally, this is actually where many of the systematic traders actually have their trigger flip points. And if we saw any legitimate breakdown below 6,700 and particularly 6,600, we suddenly have systematic traders coming in. This is critical. They are huge. And we're talking hundreds and hundreds of billions of dollars of orders in vol targeting funds, CTAs, and dealer gamma positioning. The one thing I want to highlight is systematic traders, there's no emotion and there's no discretion. When these triggers happen, hundreds of 100+ billion dollars to sell is going to hit the bid systematically without deciding that it's a good idea or not, or any bull story or thesis you want to make. The point is that this trigger point is right below where the market is trading. In fact, today we were right at the edge of the cliff on the S&P 500 before the bulls managed a huge recovery reversal a second time, 2 Fridays in a row. We had Friday sell-off last time. They did a big save. Friday sell-off today. Again, a big save. On the short term, they're keeping the market from falling off the cliff. Why that Nvidia earnings is going to be that critical. Now, we have been talking about this with all of you on this channel for over a month, and with all of my members at Big Picture Trading, talking about strategies on how we can benefit from the downside moves and even potentially play upside if we're wrong about this trade. Unfortunately, I can't discuss these strategies on YouTube due to censoring, but I'm going to give you an idea on how all of you can play this. Now, if you are in the camp that believes that the bulls will prevail and all of these warning signs that we're talking about, none of them are going to trigger, and the bulls will pull the market off of the edge of the cliff and drive a year-end rally, then accept no substitute for playing further upside through bull call spreads. With the market being as vulnerable as it is, there is very little asymmetry in playing the upside with a traditional Delta One asset. And so, if let's say you were betting that this market was going to make a bullish move from up to 7,000 up to 7,400, let's say, on a big year-end rally, then taking advantage of constructing a bull call spread on the upside, let's say out to the January expiration, offers you the ability to buy that upside delta on participate on a further extension of this rally, and yet have only a small capital risk outlay without getting caught in a big market correction if you're wrong about that thesis. Now, I actually do believe this market correction is far more imminent and far more likely to happen. So I'm positioning with my members on how to play defense, which is how do I blunt the downside risk of the market and make sure the drawdowns aren't ugly in a portfolio if a market correction was to ensue. And for me, that's about also using bear put spreads. It's a very good way because at this stage, I'm not necessarily in the camp that we're entering a big 1 or 2 year bear market, nor do I think that we're going to have a devastating 30-40% market crash. I think that the market needs to deeply correct this huge rally, but that could be a 10 to 15% market correction. Some of the most logical downside targets are using previous resistance or highs, which often in technical analysis becomes support, leaves the 6,200 level on the S&P as a very clear first target zone for potential drop. Deeper corrections could go even below the 6,000 level on a temporary basis. In my mind, the easiest way to blunt some of this downside risk is simply to construct bear put spreads that somehow are blunting and or reducing losses if the market was to hit this little pocket down below. For me, the huge benefit for this is the fact that the skew steepens and there's a right tail skew on the options, which basically means opening these kind of bear put put spreads is relatively cheap. This gives us the ability to stay invested in a lot of our bigger stock market themes, but still have an insurance policy out that if one of these market corrections ensues, you have buffered that downside and even given yourself a cash inflow from the hedge that will allow you to dollar cost average some of your favorite positions if that market correction happened. Now, to do a shameless plug, I can't think of a better time to try a 14-day free trial of big picture trading, because if Nvidia's earnings is in fact a trigger point for the turn point, the next 2 weeks will encompass some of the critical moments in this entire market cycle. Every day we're online for a Where's the Trade webinar where we're talking about all the strategies with members real time on what to do and how to do it. So the next step is simple. Just click on the links in the description below and we'll see you online there.